Yesterday, oil prices fell below $100 per barrel but then began to recover. At the moment, the asset is consolidating above this mark. Watch our video review to find out the reason for such price dynamics. The point is that even before the start of Russia's military operation in Ukraine, oil was gradually gaining value, heading for the level of $100 per barrel. The main driver of its rally was concerns about possible energy shortages. Now these risks have only increased, and there are no signs of easing fears, even despite a refusal of the European Union to impose sanctions on oil and gas supplies from Russia. Therefore, oil prices will hardly drop significantly. Rather, the quotes are expected to resume their bullish run, although a quite limited one. According to the trading chart, Brent crude oil is trying to overcome the psychological level of $100. This can be confirmed by a number of signals, including the price fixation below the control level. Judging by price fluctuations over the last few days, the volume of short positions is decreasing, while market sentiment remains bearish. Thus, a local signal that the asset is oversold in the short term may well be ignored by market participants. If the price stays firm below the 100 mark, it will have a chance of returning to the levels of $90–80. At the same time, it's worth bearing in mind that news is considered the main driver for speculative moves. Therefore, signals provided by technical analysis will be overlooked by investors. The Russian currency continues to gain value. Yesterday, the spot ruble price in the Moscow exchange closed at 108 rubles per dollar. Today, the US currency is already trading around 105 rubles. The main reason for such solid gains in the ruble remains sanctions. More precisely, a refusal of the US and the EU to adopt further targeted restrictions. Initially, a rapid drop in the Russian currency was largely due to the expectations of such tougher sanctions. So the market is gradually winning back this imbalance between the reality and expectations. Moreover, it may seem that the dollar will soon fall below the mark of 100 rubles. This is indicated by transactions in the interbank market. Even before the opening of today's session, a number of international brokers reported that the quotes were trading even lower than 90 rubles per dollar. However, this can be attributed to the so-called thin market conditions. Due to the sanctions on currency transactions both from and to Russia, the market has shrunk. After trading on the Moscow exchange closes, it's almost impossible to find a counterparty to buy or sell the asset. This results in rather strange quotes. Therefore, one should not focus on the interbank market now. Traders are recommended to be guided by the first and most severe package of sanctions against Russia. Almost immediately after its introduction, the US dollar was trading just around the mark of 105 rubles. Thus, it can be assumed that the market will move within a range from 100 to 110 rubles per dollar. The wide channel stems from ongoing risks and the deteriorating economic situation. Gold is also bounced slightly after approaching the psychological level of $1,900 per ounce. This movement came as no surprise, as the yellow metal had been suffering losses for almost the entire week. A technical rebound was just inevitable. Notably, gold is still oversold. Thus, the metal still has a chance of recovering from its recent decline. A new wave of growth is possible in case the price consolidates above the $1,950 mark. However, with easing geopolitical tensions, safe haven assets, including gold, are becoming less attractive to market players. This is the main reason for its weakening. If this keeps up, gold prices may well fall below $1,900 and approach $1,800 per ounce. You've watched daily financial news on Insta TV with me, Anna Kasatkina. Stay tuned.